Ever wonder if the numbers you hear about selling a financial practice are actually real? We're talking about those whispered multiples that get thrown around, 3x, 4x, maybe even 5x revenue.
Yeah, you hear those numbers a lot.
It's a world buzzing with potential, for sure. But also, well, a lot of conflicting information and maybe some pretty high expectations. Okay, let's unpack this. Our mission today is really to cut through that noise.
Right.
We want to separate the fact from the fiction when it comes to these practice sale multiples and, maybe most importantly, uncover what truly drives value in these deals.
Exactly.
We want to equip you with the insights you need to navigate this whole landscape with absolute clarity.
That's the goal. We've spent time with a pretty comprehensive white paper on practice sale multiples, really peeling back the layers on this often misunderstood topic.
Misunderstood but critical.
Incredibly critical, yeah.
Yeah.
Our aim is to give you, our listener, a far clearer, more informed perspective. Move beyond just the anecdotes and get into the actual verifiable data.
So multiples, it's a term almost everyone in the financial advisor space has heard. Probably use it themselves.
Oh, definitely.
But what really stands out from the research is how widely its application is misunderstood.
Yeah.
Maybe even misused.
Yeah.
It seems to lead to a lot of frustration, stalled deals.
That's exactly it. And here's the interesting part. How most people think they should use multiples isn't actually their best purpose. They're not really a deal closer in themselves.
Yeah.
Instead, think of them more like a benchmark, a way to stack up results across the industry, their primary, most effective use, just as a means of comparing results from sales or valuations.
Just comparing.
Right. The moment you try to push them beyond that comparison role, the white paper makes it really clear they become, frankly, an unreliable metric for actual deal making. And this really matters because misusing multiples, it directly impacts whether M&A deals even happen.
Right.
It creates these situations where negotiations just stall out, or maybe even worse, it leads to unsound terms that can have this ripple effect across the industry. When expectations are way out of alignment with reality, deals just don't get done. Or they get done poorly, which wastes everyone's time and money.
It really sounds like we're building a house on shaky ground if our fundamental assumptions are off from the start. But why do you think these myths, these stories about sky-high multiples, persist so strongly, especially when the data suggests otherwise? What are the biggest traps people fall into?
That's a great question, and the white paper actually identifies several key traps. The first one is simply using them to assign a value or, define a sales price for a practice outright.
Just slapping a multiple on revenue.
Exactly, and that's a major pitfall because multiples are inherently just a quantitative snapshot. They completely ignore crucial qualitative data.
Like what?
Well, they don't account for the true quality of the client base or how robust the practice's operations really are or, the nuances of long-term performance. You're missing a huge part of the picture if you rely only on a multiple. Secondly, there's a really significant problem with exaggeration. Plain and simple.
The big fish stories.
Pretty much. Many of the claims you hear about these excessive multiples, like practices supposedly selling for way above 3.5x revenue, are largely just hearsay. They're unsubstantiated. The data consistently shows that practices truly getting multiples above 3.5x are, in fact, quite rare. They're outliers.
Exceptions, not the rule.
Precisely. They're the exception. And this exaggeration, of course, directly leads to the third misuse, creating completely unreasonable expectations.
Naturally.
When advisors hear these inflated numbers, they naturally set unrealistic expectations for what their own practice might be worth. And that just makes negotiation incredibly difficult. Every conversation becomes an uphill battle.
Yeah, I can see that.
And finally, these numbers are often mistaken as some kind of reliable industry-level data. The reality is, practice sales results are typically self-reported. They're not compiled at some comprehensive industry-wide level.
Interesting.
Yeah, many M&A firms provide data that's really only representative of the specific lanes or segments where they operate, not the entire market. It's actually a very narrow view.
So, if the common understanding is so flawed, maybe even based on bad data or hearsay, it's clear we need to redefine our terms. What is a multiple accurately described before we even think about applying it?
That's the perfect place to start. The most commonly accepted definition for a multiple, as our source highlights, is simply a sale price multiple of a total gross trailing 12-month revenue, or GDC.
Okay, T12 revenue or GDC. And GDC is?
Right. GDC, for anyone unfamiliar, stands for gross dealer concessions. In our industry, that's essentially the gross revenue for an advisor. So To make that really concrete, let's use an example. Imagine a practice with a T12 gross revenue of, say, $1 million.
Okay.
If that practice sells for $2,300,000, well, the multiple in that scenario is 2.3.
Simple math. $2.03 divided by $1.
Exactly. It's a straightforward calculation once you have those two accurate inputs, the sale price and the T12 revenue. Now, while that T12 gross revenue multiple is the most common, it is worth noting there are other acceptable definitions out there. Well, you might see multiples of net revenue, that's after the broker-dealer payout, or multiples of recurring revenue, which could be gross or net.
Yeah.
And for practices with more sophisticated accounting, sometimes multiples of EBITDA are used. That's earnings before interest, taxes, depreciation, and amortization.
Right, EBITDA. Common in larger deals.
Exactly. But the crucial thing is to be absolutely clear on which definition is being applied. Otherwise, you're just comparing apples to oranges.
So it's not exactly rocket science, but it is about having the right, clearly defined inputs. Garbage in, garbage out, like they always say in finance.
That's it.
And it really sounds like this fuzzy understanding, or maybe this selective hearing about what multiples truly represent, is directly feeding into what the white paper calls a newer era of speculation. It creates this environment fueled by sellers, maybe clinging to unrealistic expectations, making it incredibly difficult for buyers to structure deals that actually, pencil out financially.
That's precisely the concern. The whole market kind of gets jammed when the basic financial realities aren't aligned with these, frankly, inflated expectations.
Okay.
Which leads us directly to the core insight from the research. The main driver, the absolute key in determining the true value and the ultimate sales price of a practice. It lies in cash flow.
Cash flow is king.
Cash flow is absolutely king. This isn't just an opinion, it's what the data consistently demonstrates time and again. And cash flow plays two really critical roles in this whole valuation process. First, it demonstrates the return on investment, the ROI.
Makes sense.
It shows whether the investment the buyer is making actually provides the proper return relative to the risk they're taking and, their opportunity cost. Simply put, is this a smart financial move that's genuinely going to pay off?
Right. Doesn't make money.
Exactly. And second, cash flow directly determines the financing piece. It dictates whether a deal can even be financed in the first place, and critically, if the business can adequately service the debt obligation from that acquisition down the line. Without strong, predictable cash flow, a deal often won't even get off the ground. Or maybe it gets done, but it won't be sustainable for the buyer in the long run.
That makes so much sense. It's not just about that sticker price, is it? It's whether the business itself can actually generate the funds to make the investment worthwhile and, crucially, repay any loans.
Precisely.
And this leads us to a concept called the hurdle rate. Now, for many listening, that might just sound like another piece of finance jargon, but I imagine this is actually the fundamental sanity check for any serious buyer, isn't it?
It absolutely is. The hurdle rate is a fundamental concept in finance. Sometimes it's called the minimum acceptable rate of return, or MOR.
MAMR, okay.
This is essentially the lowest target rate of return that an investor, or in this case a buyer, expects to make on an investment to justify taking the risk.
The minimum they'll accept.
Exactly, and it's not arbitrary. It's determined by assessing several key factors. What's the cost of capital? What are the specific risks involved in this particular acquisition? What are the current opportunities for expanding the business? And importantly, what are the rates of return available from similar types of investments?
All those opportunity costs.
Right. All these factors directly affect how attractive and viable the investment looks to a buyer. So to truly evaluate this, buyers really need to develop a detailed earnings model, or what we call a pro forma, for the practice they're considering buying.
Building out the projections.
Exactly. This model needs to include the practice's projected revenue with a realistic annual growth rate assumption, not just wishful thinking. It also needs to factor in the operating expenses, again with an annual growth rate assumption. And very importantly, it absolutely must include the debt service, the loan payments for the acquisition itself.
Can't forget the loan.
Definitely not. And here's the crucial part. The net revenue after covering those practice operating expenses and the debt service must exceed that hurdle rate.
Has to clear the bar.
It has to clear the bar. If it doesn't, the investment simply isn't attractive enough for the buyer, and the deal likely won't move forward, or shouldn't anyway. Now, when it comes to the key assumptions around cash flow, most deals assume that the pre-tax cash flow will be positive right from year one.
Okay.
And significantly, it's generally expected to exceed that hurdle rate by year 3. That's a common benchmark.
Year 3.
Yeah. The good news for many deals, though, is that lender financing for most of the sales price, often with 10-year terms, actually helps deals meet or even exceed these expectations. It makes them more viable from a cash flow perspective.
So the core takeaway here, it sounds like, is that cash flow scenarios capable of actually supporting those headline-grabbing multiples, 3.5x and higher, they are, in reality, extremely difficult to achieve.
Very difficult.
And therefore, very rare. They're not the everyday occurrence that maybe the market buzz might suggest.
Yeah, precisely. While those high multiples are indeed rare, it is important to acknowledge that there are specific, often kind of unique scenarios that can influence whether a higher multiple is achieved.
Okay, so there are exceptions.
There are exceptions, absolutely, but these are very much exceptions, not the rule you should base your general expectations on. Our sources detail about 3 such scenarios. First, you might see a higher multiple if a buyer is willing and able to inject a significant amount of their own cash into the deal, well beyond what's typically financed.
A big down payment, essentially.
Kind of, yeah. Most lenders, for example, they prefer that a buyer maintains a healthy reserve of cash anyway, so having extra cash can facilitate a more aggressive offer from the buyer's side. Second scenario. Sometimes a deal involves treating a portion of the seller's equity for a stake in the buyer's practice.
Rolling equity.
Exactly. This is most common in the RIA space, and it relies really heavily on a future valuation assumption, basically, a bet that the buyer's practice will grow significantly.
So it's deferred payment tied to future success.
Right. It shifts some of that risk over to the seller, but offers potential upside. And the third scenario involves using creative or highly contingent terms. Think earnouts, for example.
Where payment depends on future performance.
Exactly. These arrangements typically result in greater risk to the seller because they only get the full potential payout if certain future benchmarks are met. But in exchange for taking on that increased risk, they offer the potential for higher overall monetization.
Got it.
Ultimately, these exceptions, they're driven more by the buyer's specific risk tolerance and their strategic objectives, not just the inherent value of the practice based on standard metrics.
Okay, but the real question isn't just what people hope for or these exceptional cases. It's what the actual math supports, right?
Yep.
And the research team didn't just speculate. They actually built, 36 rigorous earnings models, stress testing pretty much every scenario you could imagine.
That's right.
To find out if those 4x multiples were more fantasy than, finance. And the results were pretty stark, weren't they?
They were stark and very consistent. Even when we modeled aggressive growth and kept expense controls really tight, the cash flow just isn't there in most cases to justify those kinds of figures.
4 times revenue.
4 times revenue. It's simply unsustainable for the vast majority of deals, almost no matter how much you crunch the numbers in a realistic way.
Okay, tell us about the assumptions in those models.
Sure. So, to be precise, these models were built on several key assumptions designed to cover a range of typical practice scenarios. We looked at revenue growth rates of 5%, 7%, and 10% annually.
Okay, different growth speeds.
Exactly. We also factored in varying expense ratios, 30%, 40%, and 50%. And it's really important to note these ratios do not include the owner's compensation. That's separate.
Right, that's profit distribution, not an operating expense in this context.
Correct. And then for the financing structure, we used a pretty typical setup you see in the market. 80% of the purchase price financed by a lender at, say, 7% over 10 years. And the remaining 20% financed by the seller, maybe at 5.5% over 5 years, with often a 12-month delayed start on those seller financing payments.
A common structure.
Very common. And the results across all 36 different combinations of those variables, they were quite clear and consistent. Multiples of 4x and higher are simply hard to support from a cash flow perspective.
Wow.
This holds true even when you plug in aggressive growth projections and keep expenses moderate. The cash flow just isn't there to justify such high multiples under typical circumstances and financing terms.
Okay, so beyond just the raw cash flow numbers, another critical factor that the research highlights influencing multiples is how the practice is actually sold. The process matters.
That's absolutely right. The way the deal is structured and brought to market, it matters just as much, sometimes more, than the underlying numbers themselves.
Interesting. What are the main ways?
Yeah, the white paper outlines 4 general types of practice sales, and each one has its own implications for value. First, you have what's called a closed deal. This is probably the most common type. It's where a buyer and seller just find each other independently, maybe through networking, And they negotiate terms entirely on their own, often without any external professional M&A support.
Doing it themselves.
Right. Then there's the closed professional deal. Here, the buyer and seller also find each other directly, but they wisely decide to leverage professional support.
Getting help.
Yeah, for things like negotiating the finer points, handling the legal documentation, planning the transition. That added expertise can make a really big difference in smoothing out the process and protecting both sides.
Makes sense. What's next?
The third type is next gen, which usually refers to an internal transaction.
Selling to someone inside the practice.
Exactly. Passing the business to an associate advisor who's already working there, usually with professional support involved as well. What's interesting with next gen deals is that they're often sold in tranches.
Pieces over time.
Yeah. Parts of the practice are sold over time, maybe 20% now, 30% later, and so on. And the value generally increases between the first and final tranche sale as that successor advisor gains more experience and ownership stake.
Okay. And the last type?
Finally, we have the open market sale. This type is characterized by having multiple potential buyer candidates competing for the sale.
A bidding situation.
Pretty much. It's almost exclusively managed by a third-party firm, like an M&A consultant or broker, who uses a listing platform and runs a managed, competitive process. That competition is the key differentiator. And the relationship between these different sale types and the multiples achieved is actually quite direct, as you might guess.
How so?
Based on 3 years of average data compiled in the research, that competition among multiple buyers in open market sales, it naturally drives up multiples. It's basic supply and demand, really.
More buyers, higher price.
Exactly. On the other hand, those closed and next-gen deals typically garner multiples at the lower end of the spectrum.
Why is that?
Often because the seller is willing to give some concessions to their chosen successor, maybe someone they've mentored or have a long relationship with. So they might offer a slightly lower price or other more favorable terms, valuing that relationship or ensuring internal continuity over absolutely maximizing the multiple. And just to reinforce what we talked about earlier regarding the actual numbers, 3 years of real practice sales and valuation data consistently shows that multiples are falling between 2x and 3.5x of revenue.
Not the 4x or 5x.
It's definitely not the 4x or 5x that you sometimes hear whispered about or exaggerated. That 2x to 3.5x range is the reality for the vast majority.
Can you give us a sense of the average practice in that data?
Sure. To give you a concrete picture, this data includes analysis of practices with, for example, an average gross T12 revenue around $1,137,000.
Okay.
About 90% recurring revenue and assets under management, or AUM, of roughly $157 million. These are real-world figures showing the actual market, not just aspirational ones.
Right. That context is really helpful. So this brings us to maybe the most crucial point.
Yeah.
What does all this mean for you, the listener, whether you're thinking about buying a practice someday or maybe getting ready to sell? What's the practical application here?
Yeah, the primary takeaway, the big one, is really the importance of setting realistic expectations. And those expectations absolutely must be based on facts and data, not just hopeful whispers or anecdotes.
Grounded in reality.
Completely. Both parties in any potential transaction need to base their negotiations on a sound earnings model, that cash flow analysis we talked about, and crucially, a professional valuation conducted by a qualified, independent third party.
Not just optional, but necessary.
I'd say it's a necessity for a fair, transparent, and ultimately viable deal. It protects everyone involved. And when we talk about what that valuation requires, it really should include both a market approach and an income approach.
Not just one.
No, you need both perspectives. This means no relying solely on those old rules of thumb calculations. They're just far too simplistic and can be actively misleading. Additionally, the valuation itself should be recent, no more than 6 months old, ideally at the time the deal is finalized. This ensures it actually reflects current market conditions, which can change. And from a buyer's perspective, remember, any deal that involves financing has to pass due diligence by a lender.
The bank needs to sign off.
Right. And that means the financials have to show it can comfortably cash flow, even considering both worst case and best case growth scenarios.
Stress testing it.
Exactly. It also must provide a solid return to the buyer and, critically, pass that hurdle rate, that minimum acceptable return, by year 3 usually. That's what justifies the investment for the buyer and satisfies the lender. Lenders are rigorous for a good reason. They're ensuring the long-term financial health of the deal. But, it's not all doom and gloom about lower multiples. Monetization is still very healthy in this industry.
That's good to hear.
Yeah. While sellers maybe can't realistically expect to achieve those mythical 4x or 5x multiples very often, most are successfully achieving a purchase price somewhere in that 2x to 3.5x of revenue range.
Which is still substantial.
It's still a very strong return for years of hard work building a successful practice.
Absolutely. And here's something particularly insightful from the data, and maybe often overlooked, the significant value of getting professional guidance.
You mentioned the different deal types.
Right. Sellers who actually work with a succession consultant or an M&A advisor consistently achieve multiples at the higher end of that 2x to 3.5x spectrum.
How much higher?
Generally, it leads to an average premium range of somewhere between 20% to 46% compared to attempting a closed deal entirely on their own.
Wow, 20 to 46% higher. That's huge.
It's a massive difference. It really underscores the value of expertise in navigating the complexities of these deals.
Yeah, that's a powerful statistic right there. It really reinforces that both buyers and sellers alike stand to greatly benefit from getting help from a qualified M&A consultant.
No question. They can advise on what terms are reasonable. They can identify potential risks that maybe an untrained eye might miss. And perhaps most importantly, they can help ensure the deal actually makes it all the way to the finish line without getting stalled or, worse, falling apart.
Keeps things on track.
It sounds like an investment that clearly pays for itself, often many times over based on that premium.
In most cases, yes.
Okay, so to bring our deep dive here to a close, the key message seems to be this. While multiples definitely serve a purpose, mainly as a comparative tool across the industry.
Right, for benchmarking.
Cash flow truly is king when it comes down to determining the actual supportable value of a practice.
Absolutely fundamental.
And grounding your negotiations, whether you're buying or selling, in realistic expectations backed by solid data, sound financial modeling, and professional independent valuations. It's absolutely paramount for success.
Couldn't agree more. And, this raises an important, broader question, perhaps. Understanding how rigorous financial modeling, how different deal structures impact value, that's obviously crucial in the financial advisor world we've been discussing. But how might you, listening now, apply this kind of thinking to evaluate opportunities or maybe investments in your own field, whatever that might be?
Looking beyond the headlines.
Exactly. Looking beyond those initial headline numbers to really understand the underlying drivers of long-term value and success. It's a valuable skill anywhere.
That is a fantastic thought to leave everyone with. Thank you for joining us on this deep dive today.
My pleasure.
We really encourage you to keep seeking out those nuanced insights, the kind that help you become truly well-informed in a world that's just full of information but not always clarity. We'll catch you next time.